The first thing that any student wanting to study tax law should ask themselves is why? Why are we here? Why are we doing this? Why is tax important? And why do we have these things in the first place? Now, on the macro level, there's really two reasons for having taxation. Now, first of all, and most importantly, is simply to keep things running. Government can't exist without some form of funding. Now, you may personally not like what the government does. You might think taxation is theft. You might think others should pay more and you ought to pay less. Or you might think that we shouldn't have much government. It should be only an army and a police force. But ultimately, these philosophical questions really belie one consistent underlying truth, that we do have a government, we need to have a government, and we need to pay for that government. And accordingly, we've each ceded our own personal sovereignty to that government. And so, as citizens subject to law, we are obliged to pay tax. That's the main function of tax, to keep government going. However, there is quite an important secondary function for taxation. That's to achieve some form of social policies or outcomes. This secondary function is usually set up in such a way to increase the price of things. It's using the tools of economics to try and achieve policy goals, either to discourage people from doing certain things, or to try and encourage them to do some helpful or beneficial activities. Once we've accepted that tax needs to exist, we can then turn to the next question is, well, what are good features of a well-designed tax system? And again, these questions have been asked by philosophers over the last few thousand years, and a really comprehensive explanation of this was done by the famous, I guess, founder of economics, Adam Smith, in 1776, who mapped out these four things, which is largely picked up and run with even today, in that when you're taxing citizens and even artificial entities, there has to have some aspect of equality. Taxes can't be arbitrary. You can't just pick and choose who is to pay tax. We are all equal and subject to the law, and a good tax system reflects that. A well-designed tax system should also be certain. That is, individuals can plan their affairs. They can choose to save money and put it towards capital projects and undertake activities, knowing which activities are going to be taxed and how those activities are going to be taxed. A good tax system should also be convenient. That is, it should be straightforward to understand what the laws are and relatively straightforward to pay taxes that are owed to the government. Finally, a really good, well-designed tax system should also be efficient. It should achieve the two major goals. One, to actually be able to fund the government, and two, to fulfill the social policy goals that really are secondary. In order to understand how taxation works in Australia, we really need to start with a little bit of history. Now, if you go back and look at any of the great powers of the last sort of 1,000 years or so, for a long time the bulk of revenue actually lay in what we would now call custom duties. That is, money which is charged, so to speak, by the Crown or the sovereign or agents of the sovereign on goods that are brought into that jurisdiction. Now, this early on in the Australian colonies in the late 1700s and for the 1800s was one of the primary mechanisms that those colonies raised revenue also. The others were the sale of land and royalties from minerals and metals. Now, when the federal government came into existence on the 1st of January 1901, the tax base, so to speak, had changed a little bit, and it had been evolving in the late 1800s to incorporate some component of land tax, some component of what we would now call payroll tax, and a little bit of what we would, in modern terms, call income tax. But those were early days, and it didn't make up a great fraction of the tax revenue. In the 20th century, the dynamics and the relationship between the states and the territories and the federal government changed. Primarily, the power imbalance happened during the war. Because during the Second World War in particular, the federal government took over income tax. Now, the states were still allowed to tax income, and they did for some while. But after the war, the states asked for the income tax back, and the federal government actually refused to give it back. And they sort of said, look, we're going to keep taxing people. You can still do it as well if you want to do that, although it's probably not going to be politically feasible. Because ultimately, the power to tax in Section 51, subsection 2 of the Australian Constitution is concurrent. Both states and territories have the power to tax. So there were two cases that went to the High Court, one during the war and one afterwards, and these are known as the uniform tax cases, and they were resounding victories for the Commonwealth. So the Commonwealth does have power to tax income, and that is the bulk of revenue for the federal government these days, this combination of income and company tax. The states used to tax this, but since the late 50s and 60s, they have ceased to do so. One thing to note about the Australian Constitution is the list of powers that the Commonwealth has that they can legislate over. That's in Section 51. And the lists a variety of different areas: defence, banking, marriage, corporations, and so on. Now, it doesn't expressly state in the Australian Constitution that taxation is an exclusive power of the Commonwealth. In fact, it actually doesn't state which powers are exclusive and which powers aren't. In other words, the ones that can be done or held concurrently with the state. So as a result, the High Court from time to time is called to intervene to interpret the Australian Constitution. And look, it actually has a pretty commonsensical approach to it. Things that clearly involve Australia and the world, like defence or external affairs, are going to be exclusively the domain of the Commonwealth to legislate over. Whereas other things that are, particularly things that are functional, the states and territories need to survive, such as taxation, are going to be concurrent. However, it is important to note that when the Commonwealth makes legislation and when a state or territory makes legislation, Section 109 of the Constitution states that the Commonwealth statute, so the federal legislation, is going to trump the state or territory legislation to the extent of any inconsistency. Another thing to note is that while taxation is concurrent, excise is not. And there really was a common misunderstanding between the states and territories and the federal government that wasn't resolved until the 90s, where the High Court quite conclusively said that excise, that these days is largely across petroleum and across tobacco and alcohol, is solely for the domain of the federal government. So in the 20th century, there was a little bit of toing and froing in regards to whether the states and the federal government ought to tax certain areas or not. And this is largely settled down in the 21st century. And so the primary mechanism that the Commonwealth has to tax is in the income tax. And it should be noted at this juncture that when we use the phrase income tax, we refer to both individual, so the taxes to individual natural persons, as well as companies. Also note that in Australia, when we refer to capital gains tax, that is actually folded into the income tax itself. Even though we analyse it as a different area, functionally it's still paid in the same mechanism as income tax, using the income tax scales. Another important area of revenue that is managed and legislated by the federal government is the GST, the Goods and Services Tax. This only came into existence at the turn of the 21st century, and as part of the package that the then federal government had to offer to the states and to the citizens of all of Australia was to say that that money is to be redistributed to the states, and it is, using a quirky, quite complex formula. Fringe benefit tax is another tax that is levied by the Commonwealth. It's not levied by the states. That's where goods or services or some form of benefit is conferred to people in the position of employees. Royalties is an area that both the states and territories and the federal government do actually gather revenue from, both in regards to minerals and other forms of natural resources, as well as the exploitation of things like certain intellectual and intangible property rights. Excise is the amount of tax that is put upon either the supply or the manufacture of certain types of goods. And the federal government these days taxes this exclusively, and it is almost entirely across tobacco, alcohol, and petroleum products. And finally, the federal government exclusively taxes things through customs and customs duty. This is quite a complex area because it involves the international relations between Australia and other nations. And so this mechanism of taxing and putting tariffs on certain classes and types of goods from certain nations is its own area, but it's exclusively legislated by the Commonwealth. So there are some taxes that the states and territories do, and these, some of them are uniform, but most of them, the rates can vary between jurisdictions. The first one is what we call stamp duty or transfer duty. That's when assets, usually real property, but it applies to a variety of other assets, are transferred from one person to another. A percentage is paid to the state or territory government. Property taxes, these are referred to as land tax in most jurisdictions, where you pay a percentage of the value of land, unimproved land in that case. And local governments also levy something similar. We call that rates, and that's collected by local governments, even though they are creatures of statute created under state or territory law and by those legislatures. We usually use a different phrase to describe them. We have payroll tax, which is a percentage which is paid by employers, not employees, when paying staff, usually by entities above a certain size where those employees are based in that jurisdiction. And finally, the states also have royalties as well. That can be quite an important source of revenue for the states themselves. I'm going to turn now to law itself. Now, this is a quick primer on our laws and legal system. It's not comprehensive. I'm just going to talk about it for a few minutes so we can get a good basis as to how the laws of Australia and the state of Queensland work and how tax law fits into that. So the starting point is the doctrine of what we call the separation of powers. If one were to go back, say, 1,000 years, the person who ruled any particular land, these days we would call them countries, but that wasn't the case back then, is the entity or person or persons who controlled the military. They are the state. There was no true separation of powers. It was only what we would now call the executive. The king, usually, because the king controlled the army. There was no other higher power. Over the last 800 years or so in the British tradition, this complete arbitrary power of the monarch or the crown to do whatever they want has been eroded. Slowly, it's been chipped away. And in order to take away some of the absolute arbitrary power of the crown, we've given it to two other bodies. And functionally, the three arms of government perform different functions. You have the executive, which is the doer. They are the ones that actually take laws and put them into effect, so that the police, the army, all of the various government agencies form part of the executive, as does what we call cabinet. And in Australia and in the States, we have the Governor General and the Governor. They largely have ceremonial functions, but ultimately they have reserve powers to take control in situations of crises. Next, we have the legislature. That is the law-making body. The idea is that the legislature makes law, and the legislature is responsible to the people. Because if you don't like what the legislature is doing, the power that you have is to vote them out every 3 years or so. Finally, we have the courts. Now, the role of the courts is to interpret the law. So Parliament passes law, the courts interpret it, and the executive do it. They take the law and they run with it. So the ATO, for example, in regards to this particular subject, is the body who is responsible for the administering of taxation law, the Australian Tax Office. So legislation then is the most important source of law. That is where the democratically elected Parliament clearly express their will and enshrine it in an instrument which is signed by the Governor or the Governor-General. And for the remainder of the subject, we're almost exclusively going to be talking about the federal government and the Commonwealth. The courts, though, are actually still a source of law. Why? Well, a couple of reasons. First of all, for a long time, 1,000 years of the British common law system, the courts were the primary source of lawmaking. There wasn't really much what we would call legislation. Occasionally the king would craft some sort of orders, but the courts themselves were a source of law, and they were bound by previous decisions. So this doctrine of precedent is essentially a court rule, so to speak, whereby decisions that are materially similar will bind the courts in subsequent decisions. Now, the idea being that superior courts are courts of appeal, and the federal system here, that's the full Federal Court of Australia and the High Court, and the state system, that's the Queensland Court of Appeal. Decisions from those courts are going to bind courts that are below it in the same hierarchy. That's the doctrine of precedent. Now, the situations where the carefully, clearly enshrined will of Parliament, so a piece of legislation is passed, will trump the judge-made law. So if the courts make a particular decision and usually the government of the day doesn't like it, they can go to Parliament, ask Parliament to pass a law, and if that is validly passed, that will override judge-made law. But it's important to note that even in this day where we have a lot of legislation and a lot of what's known as delegated legislation, so that's where power to legislate in smaller matters is actually given to usually government agencies such as the ATO, we have a large number of bodies that can create these laws. And ultimately, though, judges are still called from time to time to make new law. That's because people really only go to court where there's something in issue, where there's something wrong with the legislation, something has happened that's fallen through the cracks. And so in that situation where the existing law is inadequate, judges from time to time are called to make new law. And we call this the common law, or sometimes the general law. Taxation law is exclusively enshrined in legislation. Judges can't make tax laws. And curiously, in Australia, the taxation laws that we have are actually contained in only a few pieces of legislation. There actually aren't many statutes that the federal government passes through Parliament that are designed to tax citizens. However, they are extremely long and very complex. Note that the different functions of taxation, different areas of taxation and different areas of administering taxation are in different statutes. And so there's really about a half dozen statutes that you need to be aware of. The first are the two Income Tax Assessment Acts. You'll note that there is a 1936 Act and there is a 1997 Act. And the reason why there's two pieces of legislation is that the Howard government in the mid-90s decided to try and modernise the way that tax legislation was set up. A very noble process. However, it didn't really adequately take into account a few key features of the Australian Constitution. See, the Australian Constitution, when it was set up, had 120 odd years of looking at how the American Constitution went. the good bits and the bad bits. One of the bad bits about the American Constitution is the idea of the paperclip phenomenon. That is where a tax bill will also have attached to it all sorts of other bills. So where particular lawmakers want to pass social policy or things that involve their particular jurisdiction. And so their tax legislation ends up being combined with a variety of other statutes, and it ends up being very messy. Now, the Australian delegates to the constitutional conventions in the late 1800s looked at this and thought that's a really bad idea. And so our constitution actually says that income tax, or all forms of taxation done by the Commonwealth, can only come through the lower house, can't come through the Senate. It can only be about taxation, and it can only be about one issue of taxation. And so one of the flow-on effects from this 100 years later, when trying to rewrite the tax legislation, it means that it takes a really, really long time. So the Act, as originally passed in 1997, was supposed to encompass all of the federal income tax rules, but in practice, really they've got about 2/3 of the way there, and it's been over 25 years. And I don't think it's going to be, the 36 Act is going to be removed in a hurry. So anybody who's coming into Australian tax law really needs to be aware of these two statutes. They're the fundamental set of laws for income tax in Australia. Note also that the drafting style of the 1936 Act is, and I really can't sugarcoat this, is absolutely awful. It is very difficult to read. It uses arcane language. It uses drafting styles that are quite difficult, particularly for lay people to understand. Some of the sections, for example, we look at have things like triple negatives in them, whereas the 1997 Act has quite a different layout and a different structure, and it has guides in it as well. So there are certain parts of the 1997 Act were actually just devoted at the start of each division to just explaining what this law is about. That's the income tax statutes. Now, the other two major federal taxing statutes are the GST legislation and the Fringe Benefit Tax Act. Now, note that the GST changes required a lot of political giving and taking. And so there were actually a series of legislations that were passed at the end of the 20th century, and with the GST Act being one of them. They all start with the phrase, a new tax system, and then in brackets, what that particular piece of legislation is actually about. It's a little bit annoying because it means that there are many statutes that start with those four words. But ultimately, that particular piece of legislation is functionally just about GST, and it's not particularly long, thankfully, as well. The Fringe Benefit Tax Act is a little bit earlier. Its drafting style is not quite as elegant as the 97 Act and the GST Act. Nonetheless, we will have to go through and examine that and the way that's set up. So those are the four key statutes that the Commonwealth have taxing legislation in. There's also an important act, which is the TAA. It's a 1953 piece of legislation, the Taxation Administration Act. That contains rules for the tax office, their powers, and how they go about collecting things. Now, it's not just the tax office, it also imposes a variety of duties on taxpayers as well. Finally, the Income Tax Rates Act is where the government publishes, essentially, the changes. Income tax and tax generally changes quite often, and it's very political. So when the budget is passed, it's usually the Income Tax Rates Act that is changed. And so the tax scales and a variety of withholding rates are stored in that one act, or rather in a few of the schedules to that piece of legislation, just so the citizen and or the tax agent advisor, and I guess also the lawyers and accountants in the world, don't have to trawl through all of the major statutes to look for rates and percentages. It's worth noting at this point the ATO, the Australian Tax Office, is a large government entity which is charged with administering the taxation law. A couple of things to note about the ATO. They have massive powers. They have a variety of mechanisms at their disposal which have been given to them by Parliament. However, our tax office actually operates in quite a collaborative way with taxpayers. And as part of the ATO's, I guess, mission statement, it is trying to be as open and transparent as possible. One of the pushes that the ATO has had in recent times is to try and have everything digital and published on its website. So it's really important to note that in dealing with Australian tax, that the ATO website, which is ato.gov.au, is a critical resource, possibly the primary resource that tax practitioners use for trying to determine what and where the law is and how the tax office has gone about interpreting it. It is also the portal that the tax office uses for interacting with taxpayers as well. So while the ATO does have a very strong mantra of collaborating with taxpayers, it is important to note that in situations where they suspect you're doing something wrong, they have very, very broad powers to administer the taxation legislation. They have statutory rights to enter premises, to make people appear and to question them and cross-examine them. They have powers to audit. They have the power to data match between certain types of entities, financial institutions, and various government agencies that they can use to do this process called data matching. Data matching is where they look at how your records present to one agency and compare it to how that's been implemented in your own tax assessment. So, for example, if you declare a large income but to the tax office but a very low income to the Child Services Agency, for example, the function of the ATO where they can use powers is for benchmarking, which is to basically compare industries, where they're going and looking at how the taxation laws are working and doing analysis based on that. They have the power to go through to analyze data as a result. There is also the ability of the ATO to make tax determinations. They're given powers to determine what the law is in certain circumstances and to make rulings. They can make public rulings that are going to apply more broadly and private rulings for individual taxpayers. And note that those rulings that they make will bind the tax office themselves. Now, when a taxpayer comes into some form of dispute with the tax office, there is a structured process to go about resolving these disputes. And the first step before you can go to either the AAT or to the courts is to essentially ask the decision maker, in this case the tax office, to remake the decision. So if you think a bad decision's been made, you can ask them to remake the decision by raising what's called a formal objection. Usually this is to tax assessments, but it can be to other decisions that the tax office make in the process of administering taxation law. And if you don't like a particular decision, you can go by right and have that particular decision reviewed by a body called the Administrative Appeals Tribunal. This is a statutory body, and technically it's not a court, it's a tribunal. So it, in its role, is to step into the shoes of the original decision maker and remake the decision. In other words, all of the information that was presented to the tax office originally, and any additional information the taxpayer and the tax office present to the AAT, and then they will remake the decision, looking at what the applicable law is to reach the correct and preferable result. That is, in most situations, the first step that a taxpayer can take if they are dissatisfied with a review of the ATO internally. There are some mechanisms for seeking additional review or appeals in regards to taxation decisions. So the first step, if you're dissatisfied with the decision, is to seek a formal objection. Now, you're going to have to do this regardless of whether you wish to seek review in the court or to appeal it to the AAT. So that after the tax office has essentially remade the decision, if you're still dissatisfied with it, you can then go to the AAT. Now, if you don't like the decision of the AAT, you can appeal that decision to the federal court, to a single judge of the federal court. However, there is an additional mechanism that you can use, which is what's known as judicial review. Now, if a government body, and it's not just the tax office, if any person administering a piece of legislation makes a decision that is contrary to law in some way, you can seek what's called judicial review. That must be done through the courts. So that from the initial steps, you can actually bypass the AAT, but you can only do it on issues of law. You can't do it if there's a dispute about the facts in regards to that avenue. But in either way, either seeking judicial review from the original decision and going to the federal court, or seeking the AAT to remake your decision and then appealing that to the federal court on an issue of law. Once you're in the federal court, if you are the taxpayer and you lose, you can appeal that to the full federal court. That will be only on issues of law, and 3 judges of the federal court will review the decision that was made by the single judge in the federal court. There is an additional way that you can appeal, assuming that you lose in the full federal court, and that is to seek leave to appear in the High Court. It is exceedingly rare that the High Court will hear your matter. You aren't allowed by right to go to the High Court. You can just essentially ask them nicely. We call this seeking special leave to appeal. It is only granted in exceptionally rare situations. Usually in a situation where the matter is of great public importance. For example, if it could affect a large number of other taxpayers, or if it affects substantially the revenue-making powers of the Commonwealth, or arguably a state government as well. Turning now to taxpayers themselves. Now, we use this phrase taxpayer in, I guess, a generic sense, and it certainly applies to human beings, to natural persons or individuals. And it's important to note, though, that also equally applies to artificial entities, that is, things that are created either by statute or by royal decree. And it applies to certain types of non-entities, so things that don't have legal personality, but nonetheless a tax return has to be submitted, and they have what's called a tax file number. So trusts, company groups, partnerships, and certain types of unincorporated associations are still going to be deemed to be taxpayers. We're going to use those words interchangeably here. Another thing to note about the Australian system of taxation is that it uses what we call self-assessment. That is, the ATO is not going to tell you how much tax you're going to have to pay. You have to calculate that amount, and you have to pay that amount on time. So the ATO's role, so to speak, isn't to check what you've been doing and then tell you how much to pay. You have to work that out. If you do it wrong, they'll follow up, and they have extensive powers to do so as part of that. So it's a really important thing to note that our system really only works because 97-98% of taxpayers just do their tax returns, do it properly, and pay their tax. And that's how our system functionally works. And so a lot of the time when the ATO is bringing actions as a result, it's to maintain the integrity of that system. So where people are cheating or just being reckless or negligent in doing their returns, particularly when they're getting some sort of benefit, that they'll be prosecuted, not because the individual amounts are important to recover, but because tax office needs to set an example. Another thing to note is that taxpayers, while you can do your own tax returns and submit those things and pay the money, you can also get a registered tax agent to do them for you. So registered tax agents can be paid, whereas third parties who aren't registered tax agents that do tax returns can't be paid. And in doing so, just by the nature of the tax agent role, they have the ability under the administrative statute to submit tax returns for their clients all year round, rather than just at the bottleneck times of year. So as a result, if you get a tax agent, I guess the logical step of that is that you get extra time to pay. So it's an important thing to note at this juncture that can be a very powerful motivator in obtaining a tax agent to look after one's tax affairs and to do the submitting. It is important to note, though, that while the tax agent does the returns, it's still the taxpayer who's liable to pay tax and who must meet the time frames that are given. Now, it goes without saying that tax law is complex. It's a challenging area of law. There are lots of rules, and there are lots of exceptions to rules. And the reason that those exceptions come about largely flow from political needs. Different types of taxpayers are taxed in different ways and have different rules that apply to them in terms of how they go about completing their returns and the amounts that they have to pay. And broadly speaking, the different types of categories of taxpayer change depending on the type of entity, so that companies have different tax rates, for example, from individuals, from actual human beings. The size of the entity will change how certain rules apply. So very, very large entities have quite different reporting requirements and different rates that apply to them. Different industries also have special rules as well, so that there are particular rules for tax for banking, for example, or for importers or exporters, and for farmers, so primary producers. There are also rules that will change depending on certain family relationships, for example, so that if you're a settler on a trust and also a trustee, for example, or if you are having to calculate the Medicare levy, it looks at the income of your spouse, for example. Similarly, corporate groups have certain rules for combining their returns in order to determine their true tax position as well. And an important one that we need to look at forthwith is what's known as residency. The idea that Australian resident taxpayers have different tax rules to non-residents. It probably goes without saying that when dealing with taxation, you've got to keep really good records. The reason for that is that you are going under our self-assessment system to go to the tax office and state unequivocally and sign to say that the particular amounts that you're including in your tax return are true and correct. Additionally, if you wish to claim things like tax deductions, you have to be able to substantiate those. So you have to be able to produce records upon request to demonstrate those particular claims. So these things have to be done in writing. They can be done digitally, but functionally they have to be kept. Oral statements aren't going to be sufficient. Students of contract law may recall that you can have contracts that are verbal, but in order to substantiate those for tax purposes, they're going to have to be in writing. Now, other parts of tax administration require additional substantiation amounts, and an example here is logbooks. So, for example, if you wish to claim a certain number of kilometres that a vehicle has travelled for work purposes as opposed to non-work, you'd have to retain a logbook. Note that there is a general penalty for just failing to keep adequate records. And like a lot of these penalties, that if the tax office does do an audit and you are found to be at fault, and you're found to not just be at fault but also have to pay more tax as a result, we call that a shortfall amount, and there's a very high penalty interest component that is added to that as well. So know that this failure to keep records can lead you liable to an administrative penalty. And so it's a really good habit to get into when doing and dealing with tax matters, to get into this habit of keeping very clear, accurate, and consistent records. I'm going to turn now to the single most important topic, really, of this entire subject, which is income tax. Income tax is the main tax. It's the primary source of revenue for the Commonwealth, and it's the predominant mechanism in which our federal government essentially funds itself. So there's going to be some basic pieces of information, and this is often common knowledge to people who've lived or resided in Australia for some time, but it is worth spelling this out, that Australia runs a self-assessment system, so the individual taxpayers are required to calculate the amount that they owe and then pay it. And an important piece of information is the standard Australian tax year. So the tax year, or the financial year in Australia, starts on the 1st of July in one year and ends on the 30th of June in the next calendar year. And when we refer to a particular tax year, we are referring to the end of it. So if we refer to a particular year, say the year 2040, tax year 2040 will start on the 1st of July 2039 and end on the 30th of June 2040. That is what we mean by the tax year, or the financial year, or the standard year. Those are used interchangeably. Now, taxpayers can actually ask the Commissioner to change their particular tax year, and that's done on a case-by-case basis. But the vast majority of taxpayers have the 30th of June, which is the cutoff. And the idea is all of the relevant transactions between the 1st of July the previous year to the 30th of June of the current year are taken into account for the purposes of determining the amount of income tax that a taxpayer has to pay. Now, for individuals, once that is done, you've got until the 31st of October to lodge that. All right, you lodge, but you don't have to pay at that point in time. If you do owe money to the Commissioner, then you'll have a period of time in which to go through and pay that. A couple of other things to note. Sometimes the phrase company tax gets thrown around. That's just incorrect. So as a piece of information, there's no such thing as company tax, so to speak. Companies, or rather anything other than an individual, are subject to quite different tax rates and different rules, but functionally it's all income tax. It's all really the same thing, and it's calculated and paid and managed through the same pieces of legislation. Another thing to note is that there's really no separate capital gains tax as such. Again, capital gains are still calculated, but once those are calculated, when you are assessing and calculating the amount of income tax you pay in a particular year, that amount includes net capital gains for that particular tax year. So it's helpful just to start with this nomenclature and really tuck this away, because these particular pieces of information are going to come up again and again. So turning now to, I guess, the absolutely most base fundamental principles of income tax is understanding these three concepts. This concept of assessable income, taxable income, and tax payable. Once you've got your head around each of these three things, the remainder of topics that we'll have in regards to income and to deductions are going to be much easier. So assessable income is the aggregate amount of income that comes into a taxpayer in a particular tax year. Right? That is the amount that comes in before applying any allowable deductions. We call that assessable income. Taxable income is that amount less those deductions. Okay, so taxable income is going to be smaller, usually, than assessable income. And it's taxable income that we then take and put into what we call the tax scales. For some entities like companies, that's just a flat percentage. For other entities and for individuals, it uses what we call a progressive scale. Once we've put the taxable income through the tax scales, that will calculate the base amount of tax which is going to be paid. And there's one additional step, which is once you've got that base amount, to take away from that any tax offsets that are available to that taxpayer for that particular tax year. So it's a three-step process. Calculate assessable income, then take away from assessable income the allowable deductions to get the taxable income. Once you've got the taxable income, put that through the tax scales to work out the base amount of tax payable. Once you've got that base amount, take away any offsets that the taxpayer is claiming. That final amount is the income tax which is payable for that taxpayer for that particular tax year. For those people who are mathematically minded and would much prefer to have things in a formula, TI, or taxable income, is equal to AI minus AD. In other words, taxable income is equal to assessable income less allowable deductions. And then ITP, income tax payable, is equal to the TI, the taxable income, multiplied by the relevant tax rate. Now look, it's a little bit of a hack here. For things like companies, where there is a flat tax rate, then that would just be a simple percentage. For individuals and most other entities, it's actually going to be a series of different rates. But we'll address that at a later stage. Once you calculate that, that's the base amount of tax, then you take away TI, which is tax offsets. So that, I guess in its very basic, very raw sense, is the income tax formula. To extend this formula, the calculation of assessable income actually has two components to it, which is what we call ordinary income, come under ordinary concepts, and statutory income. That's income that isn't what the courts would consider to be income, but nonetheless Parliament has said will be deemed income. And so income in the ordinary sense, we call that essentially the common law test. That was really what you and I would consider to be income. Income from rent, income from personal exertion, income from business. Statutory income includes things like capital gains, things that weren't originally income in the ordinary sense, nonetheless are included into your assessable income through this formula. Also note that assessable income does not include exempt income and another type of income called non-assessable, non-exempt income. Now, we're going to look at these and this distinction between these two concepts later in this subject. But the key thing you need to note here is that in almost all situations, non-assessable, non-exempt income is better. Why? Because you can usually offset it with deductions, even though you're not going to be paying tax on it. It just needs to be reported. Whereas exempt income, usually you can't claim deductions against those things. Really, in the simplest sense, that's all you need to know at this stage. And make note that you can have this non-assessable, non-exempt type of income for both ordinary and statutory income, and you can have exempt ordinary and exempt statutory income also. Tax rates for individuals have a tendency to change quite a lot. The reason for that is political. The various sides of politics generally throw around tax policy as a point of differentiation between the two, with the left happier to increase the tax rates for higher income earners, and the right of politics usually wanting them to be a little bit flatter and to better align with the company rate. So the tax rates for individuals that we presently have are in theory locked in for the next few years. but in practice subject to change depending on which government's in power. So the couple of things to note, there's a thing called the progressive tax system. What does that mean? It means that the effective rate of taxation, or the marginal rate, increases the more that a person earns in a particular year. So the first dollar you earn actually falls within what's known as the tax-free threshold. So resident taxpayers actually don't pay any tax at all for the first $18,200 that they earn in a tax year. Then, for the next dollar that they would earn, they'd have to pay 19 cents for each dollar up until that amount hits $45,000. Then every dollar beyond $45,000 you'd be paying 32.5 cents to each dollar, up until 120,000 Australian dollars per year. Then between 120,000 Australian dollars up until 180, you'd pay 37 cents to the dollar. And finally, for every dollar that you'd earn beyond 180,000, you'd pay 45 cents. Okay. This is known as the marginal rate of tax. And note that this doesn't include a variety of other levies that we'll come to at a later stage, particularly the Medicare levy. So a couple of things to note here. First of all, this only applies to resident individuals. Again, we'll analyze what it means to be a resident. And it only applies to individuals. So that this idea of individuals, which includes the self-employed, people that are sole traders, the idea is that the more that you earn, the higher fraction of each additional dollar you'll pay. However, and this is an important concept, because a lot of people get this wrong. If you, for example, earn maybe $179,999 in a particular tax year, earning one more dollar will not radically increase the amount of tax that you'll have to pay. In fact, earning that one extra dollar will literally only cost you an extra 8 more cents than what you would otherwise have paid in tax. All right, people seem to conflate this idea of tax brackets with having jumping a tax bracket automatically means you pay a lot more tax. That's simply factually incorrect. It's a progressive system. The percentage changes when you hit certain thresholds, but you don't become liable for a large sum of money by going over it by $1. That's just simply not how progressive tax system works. Note that this, unfortunately, is not true for some other areas of tax, particularly the HEX system and the Medicare system as well. But we'll get to those in turn. Tax rates for companies are much simpler than individuals. There's basically two types of companies, and a company in a particular tax year can either be deemed what we call a base rate entity or not. And the idea is that base rate entity companies have a tax rate of 25% and others have a tax rate of 30%. So for every dollar they would earn, you either have to pay 25 cents or 30 cents. And the test to determine whether or not a particular company is a base rate entity is that it has to satisfy both of these tests. It has to have at least 20% of its income being active. Active income is contrasted with passive income. Passive income is things like interest, dividends received from portfolio investments, rents, capital gains. We call that passive income within the meaning of the Ratings Act. And if at least 20% of your income is not passive income, or in other words, is active, and the turnover, the aggregated turnover of that particular company, which again has its own definition, but in broad terms just means your sales and income in total. If that's less than 50 million Australian dollars, you're deemed to be a base rate entity, basically a small company, and you pay a 25% rate of tax. Now, larger ones, or ones that don't meet that threshold, in other words, more than 80% is passive income, are obliged to pay 30 cents to the dollar. One really important conceptual area that students of tax law have to wrap their heads around quite early is the distinction between deductions and offsets, and to a lesser extent credits as well. So a deduction is something that we use to take the assessable income and reduce it to work out what the taxable income is for a taxpayer for a particular year. So a deduction merely reduces the amount that the taxable income is in order to then take that taxable income and put it through the tax scale. An offset, in contrast, after the tax scales have been applied and you've worked out the base amount of tax payable, offsets reduce that. So as a result, for example, $100 deduction to the taxpayer is only worth really about a third of that, or whatever the particular marginal rate of the taxpayer is to that particular entity or individual. Whereas an offset, assuming that a person is paying tax in a particular tax year, is 1 for 1. So for example, if you have an income of more than $180,000 as an individual, you would pay 45 cents to the dollar, again, leaving aside the Medicare levy. If you got a deduction of, say, $1,000, that's worth $450 to you, because that's the amount of marginal tax that you won't be paying. If, however, you were given a $1,000 tax offset, that would be worth $1,000, because that's going to reduce the amount of tax payable for that particular year. Now, if the amount of offsets exceed the amount of tax that would be payable, they're just disregarded. And here there's something of a distinction in terms of the nomenclature in the various pieces of tax legislation. And unfortunately, it's not consistent, particularly in the old Act. And so colloquially, we use the term tax credit to describe things that can either be carried forward or in some places refunded to the particular taxpayer. So the idea is that offsets by default are just going to reduce the tax that's payable in 1 year. In some situations they can be carried forward, and in some other rarer situations they can also be refunded after you've done your particular tax return in a particular year. And the idea is that you would apply offsets, which are going to disappear anyway first. Then you would apply credits that are carried forward next, and then you would apply credits that can be refunded last, and anything that's left over will come back to the taxpayer. So it's really important to get your head around these three, and really this idea that credits that are refundable are worth more than credits that are carried forward. Credits that are carried forward are worth more than offsets, and offsets are going to be worth more than deductions. You know, when Donald Trump was president, he famously said, "Healthcare, I can't believe it's that complicated. Who could have thought healthcare could be so complex?" And to which the rest of the entire planet said, well, everyone knows that healthcare is complex, both its implementation and also its funding. Now, in Australia, we have a comprehensive public health system, and that's accessible to anybody who has what's called Medicare. Medicare is in part funded through some levies, and those levies form part of the income tax system, which is why we need to know about them, because the ATO collects this money, and functionally it just adds to the taxes of individuals. And so there's two of these levies that we really need to be aware of as tax law students. The first is the Medicare levy itself. This is a tax of 2% of a taxpayer's entire income, provided that they are eligible for Medicare and their income goes beyond a certain threshold. It's quite a low amount, sort of around about 30,000 Australian dollars. There's a shade out amount as well, so So people between sort of 22, 23,000 pay a lower rate. That's outside the scope of this subject. Note that people who aren't eligible for Medicare are not obliged to pay this levy. So the people that are eligible are Australian citizens and permanent residents, the holders of humanitarian visas, and New Zealand citizens residing in Australia. So this is the Medicare levy, or ML, and that is different and distinct from the Medicare levy surcharge. This is an additional tax of between 1 and 1.5%. Again, that applies to all of a taxpayer's income if their household income goes over a certain threshold or series of thresholds, and that taxpayer does not hold private medical insurance, with the idea being that individuals with high marginal tax rates are encouraged to spend money on private medical insurance as part of it. Now, this tax, which is different and distinct from the Medicare levy, is known as the Medicare levy surcharge, or MLS. So it's important to note, because usually when we are analysing tax law, we often look particularly at the top marginal rate, and we take into account the Medicare levy, but not usually the Medicare levy surcharge as part of that. So you'll see that this comes up, and often throughout the subject in regards to these marginal rates, there will be mention of this Medicare levy. And again, like other aspects of income tax, it is liable to change depending on the political climate. Another component of our tax system more broadly is the HECS system. Now, our education system in Australia is quite expensive, and Australian citizens are entitled to have some fraction of their tertiary study essentially moved into a government-backed student loan. Now, this debt to the Commonwealth is different from ordinary debts, in that it can't be sort of assigned in the general law. It's not liable to go to debt collectors, but it can be changed in terms of both the repayments and the amount of interest or indexation that happens to it by legislation. And so there have been a few changes over the course of the HECS help and fee help, vet help and so on, over the course of the loans being in existence in terms of the interest rate of these. So that's something to be mindful of. For the purposes of income tax, though, the key thing to note here is when a taxpayer, an individual taxpayer, is doing their tax return, that there are compulsory repayments that have to be made, and they kick in when the taxpayer earns over a certain threshold. Now, unlike other aspects of our progressive tax system, if you earn $1 over the threshold, you will get a percentage of your entire income that you'll have to be repaid. Now, the reason why this isn't so politically outrageous is that functionally it's the taxpayer repaying their own debt. So really, in some ways, it's your own money being moved from one place to another. But it is important to note for students of tax that when you hit the threshold and you start to pay that 1%, you will literally earn $1 more and have to pay sort of $500 towards the repayment of your student loan. And so that can be a little disconcerting, because it creates some sort of perverse incentives to try and manipulate income to meet or not meet certain thresholds in regards to that. So it's an important thing to note. We don't look at this in any more depth in the duration of the subject, but it is something for those that end up in tax practice to be aware of, because it's difficult to sort of explain to people that HECS repayment is not a progressive system, at least not in the conventional sense. One really important rule that students of tax law have to get to grips with very early are the concepts of residence and source. And while there are a variety of reasons why we need to know this, the single most important one is that Australian residents are taxed on their worldwide income, whereas non-residents are only taxed on their Australian sourced income. Thus, the rules for determining whether a person is resident as opposed to a non-resident, and whether a packet of income is Australian sourced or not Australian sourced, are very important concepts to understand and to get to grips with very early on. Note that there are some other rules or reasons for determining residence and source. For example, the tax-free threshold actually doesn't apply to non-residents. Non-residents don't pay Medicare. The tax-free threshold will actually only apply to a person who's resident for the full year. So if you're a resident for part of a year, then for that part you won't get the tax-free threshold. And one really important point to make, because it's quite confusing, is that when we talk about being Australian resident for the purpose of tax law, this is a completely different concept to residency in regards to migration law. So residency, both permanent and temporary, and citizenship are quite different concepts than resident for the purposes of tax law. So when we're trying to determine whether or not an entity or an individual is a resident, we have to go to the old Tax Act. And like many things in the 1936 Act, it's not the best written thing. So I've actually taken it and just paraphrased things slightly. So if you are able to read the slides, you'll just notice that it'll read slightly differently to how it reads in the actual legislation itself. But I'll just run through it now. So the word resident means, in any form of definition in a piece of legislation, where it has the word means, it means that it takes that ordinary definition and just throws it away and says, all right, we're going to define what this word means. So it means, and it's got two parts, an A part and a B part. And the first part, the A part, is to do with a person. So a person other than a company who ordinarily resides in Australia. Okay? And that's important, that first part, because even though when I said it, the word means throws away that ordinary definition, this part brings it back again. So we will start with the ordinary meaning of resident. So it means that this definition of resident for persons start with the ordinary, or what we call the common law test of residency. But it also has three other tests as well. And the first one is the domicile test. So a person whose domicile is in Australia, unless the ATO is satisfied the person's permanent place of abode is outside Australia. So a couple of things come from this, and again, we'll break down these things in a bit more depth, but domicile is usually related to citizenship and visa status. And where it says the ATO is satisfied, in the actual legislation it has the word commissioner. It's probably easier to understand that as being as the tax office itself, because while technically it is one person, the Federal Commissioner of Taxation, in practice she or he delegates extensively. And we will have to look at this permanent place of abode. But a couple of things to note. Where it says unless the ATO is satisfied, it means the ATO has some discretion here. The second test is where a person who actually has been in Australia for more than 1.5 the year, or in other words, 183 days. Unless, again, the ATO is satisfied that both the person's usual place of abode is outside Australia and that the person does not intend to take up residence in Australia. That's the third test. That is the 183-day rule. The fourth test, and look, this is a corner case. It's where a particular person, an individual, is still a member and contributing to certain old types of Commonwealth superannuation schemes. And note that any person that started to work as a public servant after the 1st of July 2005 is no longer eligible to join those schemes. It's only people who started a long time ago and who have carried on contributing to those things and haven't retired yet. And so note that that fourth test, that superannuation test, becomes less relevant as time goes by. We're also going to look at this second part, so where you've got a company. So a company which is incorporated in Australia is going to always be an Australian tax resident. That's a really important rule. All Australian registered companies will always be Australian tax residents. However, where you've got a company which is not incorporated in Australia, but both carries on a business and either has central management and control in Australia, or its voting power controlled by shareholders who are residents, will also be a tax resident. If you were to read about the test of residency for individuals in textbooks or on the ATO website, they'll talk about the 4 tests as 4 distinct items, but ultimately those 4 items come from that definition in the old Tax Act. And so this idea of the ordinary concept or the common law test, the domicile test, the 183-day rule, and the superannuation test. Those are the 4 tests for individuals that we have to go and look at. And look, if any of them are satisfied, for the purposes of tax law, you're going to be deemed to be a resident taxpayer for that year. Note that the same is not true for the purposes of the tax-free threshold. For that test, in order to get that particular benefit, you must demonstrate all 12 months. And if you can't demonstrate all 12 months that you were a resident, then the months that you aren't Australian resident, you won't get the tax-free threshold. So you have to pay a little bit more as part of that in the bottom tax bracket. So the first of these 4 tests is the ordinary concept test, also known as the common law test. Why? Because we just ask ourselves ordinarily, what does it mean to be resident? What does it mean to reside in a place? And the courts look at a variety of factors that they've developed over the last 100 or so years. And so the frequency, length, and duration of visits, time spent in Australia, whether or not a particular taxpayer owns or maintains a house in Australia, whether they have some sort of physical presence, also things like whether or not they have bank accounts. They'll also look at the nationality that's stated on the passport. You can look at the custom forms when you fill in the form when you're entering Australia or leaving. They can look at the nature of visits. Are you coming to Australia just for a holiday, or are you coming here to work? All of these non-exhaustive list of factors are things that the courts will look at for determining this. And a lot of the time this actually overlaps with the other tests. Hey, if you're here for more than half the year, or you have a domicile here, or whatever reason you're in one of those, you've got some form of strong financial connection to Australia, all of these things can be taken into account by the court for trying to determine whether ordinarily you are an Australian resident. And note that if you are ordinarily a resident, then you don't need to look at any of the other tests. You're just going to be deemed a resident. The second test for residency for individuals is known as the domicile test. Now, the domicile test does actually flow from your citizenship status, your visa status, and we start with the idea that a person's domicile is usually acquired at birth. So that if you are born in Australia to Australian citizen parents, you will have Australian citizenship. And so by default, you're going to be domiciled in Australia. Okay, now people can change their domicile, either moving with their parents, but also when choosing to move to other nations. Okay, but the key thing to note about the domicile test is it's the intention to migrate, not merely to go and live in another place for a period of time, particularly a period of time to work. And so in Jenkins, for example, they looked at an intended stay of 3 years. And they said that, look, that's still not going to be a temporary thing. And so this idea of the permanent place of abode being outside Australia is this second part of this test. They look at whether or not a person is moving, tending to migrate, and doing so for a long period of time, okay? More than merely a temporary length of stay. And it's okay for somebody to go overseas with the intention of one day returning to Australia. Again, Jenkins, it was 3 years. And they said that, look, ultimately, that's not a temporary length of time. You have moved out of Australia with this intention of staying out and staying away for a really good chunk of time. And so that this idea of permanent place of abode, permanent is not the same as forever within the meaning of this particular test. For the third test, this 183-day rule, this is mathematical. You just count how many days you've been physically present in Australia. Part day counts as a day, and the days don't have to be consecutive. So they literally can look at your migration status, when you entered, when you left. Does it equal more than 183 days? If so, you are Australian tax resident. Now, again, the Commissioner has discretion to deem a person not to be a resident, provided that both the usual place of abode is outside Australia and there's no intention to take up residence in Australia. And so that intention to take up residence, again, can be expressed over a long period of time. So it's the key thing to note here is that this will automatically deem a person to be an Australian resident, and ultimately it's up to that taxpayer to make the argument against that in order to not be deemed to be Australian resident for that period. The fourth of these tests for residency for individuals is the superannuation test. Look, this is a corner case. It doesn't come up very much. Politically, it wasn't a really good look when government employees were obtaining really good superannuation benefits and be able to go into these quite lucrative schemes. Then they would be posted overseas and not be paying Australian tax. It wasn't a good political look, and so this test was added in much later than the other tests, so that those people would always be deemed to be Australian resident for the purposes of superannuation. Note that these particular schemes stopped in 2005, so it's only people who are both members and paying into these schemes and not retirees, and have done so before 2005. You haven't been able to do that from that point onwards. So again, it's something of a corner case. But note, though, that it actually deems both their spouses and their children under the age of 16 to also be considered to be tax resident also. So that's just, again, it's a corner case, but it's worth noting. The test for residency for companies is a little simpler than it is for individuals. There are 3 tests, and the first one's dead easy, which is the place of incorporation. Note that the other 2 we will have to analyse in a bit more depth, and there's been a little bit of relatively recent judicial commentary on these, which have actually kind of changed how the law works in this area. Note that much like the test of residency for individuals, if you satisfy any of these tests, the particular corporate entity is going to be deemed to be an Australian resident taxpayer for that particular year. And usually you would look at the first one first, the place of incorporation. The reason why we look at the place of incorporation test first is because if the company is incorporated under the Corporations Act, it's always going to be Australian resident. There's no way that an Australian registered corporation can't be resident. They just can't be. That's just the way the statute works. Note that there can be other forms of associations and entities that do have legal personality that have been created, and they can be deemed to be tax entities. Again, if they're incorporated, they're going to be resident. Also note that there are situations where unincorporated associations, they can be deemed to be tax entities, even where they don't have legal personality. For a company to be deemed Australian resident under the Central Management and Control test, that company would have to carry on a business and have central management and control in Australia. However, the ATO, after a series of cases, relatively recently, in Tax Ruling 2018-5, have deemed that carrying on a business and central management and control, well, the latter actually implicitly states the former. In other words, the ATO has ruled, notwithstanding the way the legislation is drafted, that if you have central management and control in Australia, you are also deemed to be carrying on a business in Australia. This is a reverse of what had previously been held in regards to this particular test. And so it might be worth just noting that even though the way the statute reads would suggest that they're two different and distinct things, the Commissioner has made a ruling that that second one, that central management control, is also going to mean that you're going to be deemed to be carrying on a business there as well. There hasn't been much judicial commentary on this, but one of the things to note is this sort of flowed from this Bywater Investments case, where the High Court went and examined a situation where there was an accountant based in Australia, in Sydney, who had a whole bunch of other people all over the world who did what they were told. So he really was this shadowy figure behind all of these arrangements, and all of the directors and managers that were in these other places, the Cayman Islands and Tonga and similar sort of tax havens, were really doing things at his behest. What the High Court said is that, look, we're going to take a no-nonsense approach to this. If people in other countries are saying that they're the directors, but they're actually really just doing what an Australian resident is telling them to, then central management control will be deemed to be in Australia, and as a result, that particular corporate entity will be deemed to be an Australian tax resident. The third test is one that examines the voting power. Basically, you need to determine where a majority of the members of the incorporated association, or shareholders for a company, are owned by Australian residents. Now, this can be an interesting test because the voting power requires you to look at whether or not the owners are resident themselves. And so this can be a little bit more complex than meets the eye, because sometimes you'll need to look at the owners to determine whether they themselves, if they're companies, are resident also. So, and then you can find, in order to determine their residency, you may have to look at the voting power of their parent too. So this can end up being a recursive set of tests where you have essentially a grandchild corporation. In order to examine whether it's a resident using the voting power test, you have to look at its parent, and sometimes you may have to look at its parent as well. So that ultimately, this chain of companies, we would have to apply the test across all of them in order to determine whether or not the grandchild is going to be deemed an Australian resident under this test or not. Turning now to the source of income. Now, the source for the purposes of tax law is important, particularly for non-resident taxpayers. And the reason for that is that non-resident taxpayers are only obliged to pay tax on revenue that is sourced from Australia. Okay, so that's one of the primary reason why we need to know the source of a particular income stream. And source, unlike residence, is really a lot more fact-based than it is a question of law, because ultimately the courts just look at where the underlying economic activity occurs from, and less weight is placed on sort of formal structures in terms of how and where entities are located, and much more weight is placed on what the actual underlying transactions are about. They look at the actual behaviour, not any sort of facade or formal structures that have been put in place. So for wages, salaries, and contracts for personal service, the source, I guess is a question of fact, is where the particular service is performed. Okay, and in situations where you are performing a particular activity or service across multiple jurisdictions, the courts again take a very commonsensical approach to just apportion these things. Now, they do apportion it across jurisdictions. So again, if you were working a third in one country, a third in another, and the final third in Australia, it would again, that would be 1/3 of those services. However, if the amount in one jurisdiction, either Australia or not in Australia, is trivial, a really small amount, the courts apply what's called a de minimis exception. Essentially, it's a Latin maxim meaning that is de minimis non curat lex. Just means the law does not concern itself with trifles. So if it's a trivial amount, 1%, no one's going to care, and thus those amounts can just be ignored. And so the vast majority of where the particular service is performed will be deemed to be the jurisdiction in regards to the source rules. Now, where you've got non-service income, where you're doing things with, I've broadly and loosely categorized these as active income, but basic income from the buying and selling of goods, or sale of real property or intellectual property. Look, for sale of goods, it's usually where the contract is entered into. That's the default position. And again, the courts will look underneath a particular transaction to try and really determine where the contract is entered into. In this idea of creating a facade and having contracts in certain jurisdictions, the courts don't pay much attention to that. They're looking at the underlying facts. But the default position is that they'll look at where the contract is functionally entered into. With real property, land and buildings, those transactions are where the property is physically located. So if it's income from the sale of real property in Australia, then the source is going to be Australia. If it's from outside Australia, it's going to be outside Australia. And intellectual property rights, again, generally where the place that the contract is created is going to be the source in regards to those sorts of transactions. When we're trying to determine the source of passive income streams, we look at the underlying asset or thing, or subject matter, that generates the income itself. So the courts, for interest, for example, they are not going to look where the contract is made or where the money's paid. They're going to look at where the loan, the actual substance that the interest is attributable to, has been advanced. With dividends, again, they're looking at the underlying transaction itself, and they're going to look at where the underlying profit is derived. They're not going to look at the contract. They're not going to look about how and where the cash is paid. They're going to look at where the underlying profits for the company have been made in order for those dividends and distributions to then be paid. With royalties, the starting point at common law is actually the place of contract. This has been modified by statute. And so that you will start by looking at where the contract for a particular contract for royalties is. But even if that's not satisfied, royalties are also going to be deemed to be Australian source if they're paid by a resident to a non-resident, unless it's wholly incurred from a business through a permanent establishment outside Australia. It also is going to be deemed to be Australian sourced if it's paid by a non-resident to another non-resident, but where the royalty is incurred through carrying on a business through a permanent establishment in Australia. So that's just something of an exception to the general rule. Note that rental income is pretty straightforward because rental income flows from real property, from land and buildings. And so that will usually be sourced from where that particular piece of property is located. Now, you might have noticed, particularly when we were talking about the rules for residency for companies, that it seems that Australia both asks for all Australian companies to be Australian resident, as well as a whole bunch of other foreign companies to be Australian resident. And as such, you could imagine if every country has similar rules, and to be honest, a whole bunch of them do, that companies would be deemed to be resident of more than one jurisdiction. Similarly with individuals, you could, for example, fall under one of the tests in Australia and an equivalent test in another jurisdiction. Thus, you'd be deemed to be resident in two places. So that's a very commonplace thing to happen. Now, as a result, there are treaties between Australia and the major trading partners that Australia has that have been set up in order to stop people from really being taxed twice. Usually what they do is they have some form of tiebreaker. So there'll be some form of test in a situation where a person's resident in both countries or a company's resident in both companies, where we determine which one's really going to be considered resident, which one's not going to be. So this, for companies, usually uses the concept of a permanent establishment in regards to that. Now, in situations, though, where you are going to be deemed to be resident across two jurisdictions, or in situations where you are going to be paying tax in other jurisdictions, there are systems in place whereby you can actually receive a tax credit in Australia for the amount of money that's being paid overseas. So the Australian government has passed through Parliament legislation allowing a tax offset. And basically it goes like this: if you are Australian resident but you've paid tax in another jurisdiction where they are party to one of these double tax agreements, then you are allowed an offset, but it's actually the lower of the amount that you did pay and the amount you would have paid in Australia. So there's no real way to double dip in regards to these things. So that assuming you've derived income off stream, if you would have earned this much in Australia but you've paid less overseas, it's going to be the lesser amount you get the offset for, and vice versa. And these are known as FITOs, or foreign income tax offsets. It's quite a complex area, and for students that are interested in this particular area, there's an advanced tax course that you can do at a subsequent stage.